All right, and welcome to the monthly recap. This is for the month ending today, October 31st, 2024. Hope you all had a wonderful month. Hope you have great plans for tonight for Halloween. So it was a very weird month. I'm not going to say busy month because from a Fed meeting perspective, from a data perspective, it wasn't that busy, but it was very weird. I'm going to be talking about why. There's a lot of external factors currently at play. Going to be talking a little bit about that. Going to be talking about the latest information from the inflation and unemployment figures, a little bit of change there, but I'm going to talk about why I'm not overly concerned. So don't stress there. Fed meeting fallout, that's kind of the big one. So Fed cut rates on September 18th by 0.5% first rate cut in years. And then what did rates do? Well, they went from 6.125 approximately to about 6.875, almost 7% in some scenarios. So it was a very weird month. I'm going to be talking about why this happened and then where do I think rates are going to go from here. So it's Indigenous Peoples Day, obviously fall is in full swing, weather's changing quickly, and then Halloween again, happy Halloween. So let's get into all of it. Let's start with the external factors. Okay, so earlier in the month, there was a longshoreman strike. Longshoreman strike, it was a union of dock workers, okay? And they were specifically striking on the East and Gulf Coast ports. 43% of all U.S. imports flow through that, which is pretty crazy. This could have had a huge impact on inflation, because if goods are getting stopped up and if goods can't be delivered around the country, anything from vehicles to televisions to everything in between would kind of get held up in these ports. That could have been really catastrophic for the economy. It could have been really, really bad for inflation because, inflation simply is a lot of money chasing limited goods. Right. And if those goods are all being held up, it's going to limit the amount of goods. Right. So good news is it was very short-lived. The bad news, it was only suspended. Okay, so it's been temporarily suspended until January. So more to come on there in a couple months, most likely. Unfortunately, hopefully everything gets taken care of. But it's really like kicking the can till the election's over and then let the next administration kind of deal with it. It is basically the path that was taken. There's also obviously escalation in the Middle East. Tensions increasing now. Fear over how far that may spread. Every single time there's escalation and then kind of a plateau and then hopefully de-escalation, but it could also just, take another step forward. Now, this impacts obviously oil prices. Oil prices have been all over the map. When Israel takes action, but they don't target oil fields, that's good for oil prices. However, when new steps are taken, all of a sudden there's concerns that it could impact the oil fields and oil prices. And you think oil prices, well, great, that's really just, shipping and, cars and trucks. Yeah, but it's really everything else, because a lot of the cost of goods is baked into how much does it cost to transport those goods, right? So it has a wide-ranging impact on everything. There's a reason so much attention is put on oil prices. So that can be inflationary in nature. Longshoreman strike can be inflationary. China's stimulus package, this was pretty widespread, and we didn't really pay too much attention to it over in the U.S., but we should have. China basically stepped in and said, look, we are not happy with the pace of the economy growing. So they reduced the amount of cash that banks were required to keep on hand, which ended up freeing $142 billion up to be lent out. Well, great. That's going to free up more capital to be lent out, which means there's more money to be spent. A lot of money chasing limited goods is inflationary in nature. They also lowered the down payment requirements and interest rates on homes. Again, all of that frees up capital for people to spend money. People spend money, drives the price of goods up. And then the Asian stock market hit a 2.5-year high. And then finally, you know me, I try to stay as apolitical as I can when it comes to this stuff. If you ever want me to talk politics, you get a couple beers in me and we can have some conversations. But I try to keep this completely apolitical. That being said, there is the election right around the corner on Tuesday, and there's a couple things that are facts, okay? Number one, bonds, like mortgage-backed securities, right? They offer a fixed rate of return for a fixed period of time. That's a bond. That's a promise to pay, right? Every single time somebody signs a promissory note, that is a promise to pay. That is a type of bond, okay? Bonds hate inflation because inflation eats into the fixed rate of return that those bonds offer, okay? So that is a fact, okay? Second fact is tariffs are inflationary. So there's specifically one candidate, if they get elected, they are in favor of tariffs. If tariffs get passed, that would be very inflationary in nature. It's going to drive the cost of goods up. That's bad for mortgage-backed securities. That is bad for mortgage rates. Okay, so all these different things could be inflationary in nature. Some of it's speculative, sure, but all these things can be inflationary in nature. Also, worth pointing out, none of these actually impacted the inflation figures. Okay, way too early for all of that. And like in the case of like the longshoreman strike, it's already been kind of temporarily taken care of. In the case of the U.S. election, there's a lot of speculation there as who's going to win, but we haven't really seen the impacts of any of that. In fact, even passing tariffs would be, an act of Congress, so to speak. So I mention all of that because there are some kind of headwinds that are kind of holding back mortgage-backed securities and has increased mortgage rates a little bit. We'll be talking about the other factors that's causing mortgage rates to take up here in just a second. So let's get briefly into the inflation data and the unemployment data, and then we'll start looking at some of the reasons why rates have increased as much as they have. So latest inflation data. Inflation didn't have a great month in October. Okay, headline PPI, Producer Price Index, wholesale inflation as businesses feel it. That increased from 1.7 to 1.8%. Not a huge increase, but it did tick up. Core increased from 2.4 to 2.8%. That was a pretty significant increase. Consumer Price Index, headline decreased from 2.5 to 2.4. Yay, it decreased. However, the core, which is really what they care about, core rates, if you remember, they remove the volatile food and energy components from inflation and figure out what the real inflation essentially is. You don't want to be at the mercy of, ebbs and flows in gasoline prices or ebbs and flows of, produce or poultry costs, eggs and chicken and all that. So core increased from 3.2 to 3.3%. CPI, Consumer Price Index, is inflation as consumers feel it. Okay, so it's a little bit more important than PPI. Now, again, it wasn't a great month, but there's potential relief on the way. And for a couple reasons. Number one, bellwether companies are reporting sales weakness and lowering their guidance. There's a number of companies out there that have pretty wide-ranging impacts on the economy. Starbucks was one, Heineken was one. There's many others. And a lot of them are saying, like, look, we're not seeing a whole lot of good news on retail sales. Some of them are saying, look, we're going to lower our guidance, how much we think we're going to be having sales in the future. Some of them are just cutting guidance entirely, saying, we're not going to tell you what's happening day to day anymore. We want to get our feet underneath us before we start to report some real-time numbers. Well, there could be some relief on that front because if they have to lower their costs, right, to stay competitive, that drives inflation down. Okay, trend still lower. If you look at the last 12 months of inflation, it has been going down. We had one bad month in October, sure, but generally speaking, it has been going down. And then lastly, shelter costs. I've talked about shelter costs before in these updates. They make up about 36.1% of the inflation figures. That's huge, right? That's over a third of the inflation figures are shelter costs. How much are people paying for owner's equivalent of rent? How much are people paying to live in their house, right? Well, CoreLogic, which reports like real-time data on shelter costs, they reported rents have increased 2.4% year over year. Inflation reports are currently baking in 4.85% increase year over year for rents. So again, this doesn't seem like a huge difference, 2.4 versus 4.85, but when it's making up 36% of the inflation figures, it has a significant impact in all of that. So, this shelter has been lagging. Once it starts to play catch up, it should just continue to drag inflation down. Lowering inflation would be good news for mortgage-backed securities. This comic is so funny. It's from 2021, but it's still here, inflation monster. It's only transitory. I mean, back in 2021, we were all thinking inflation was transitory. The Fed was saying that. All the traders were saying that. I said that. We all thought it was just going to be temporary. And here we are, 3 years later, and we're still dealing with elevated inflation. But again, there's some reason to hope that inflation should be coming down. There's, relief on the way, especially once that shelter component starts to play catch up. Jobs. So what's going on with jobs? I mean, we've seen significant swings on the unemployment front. In August, we saw it go from 4.1 to 4.3%. In September, we saw it go from 4.3 down to 4.2. And then last month, we saw it decrease further from 4.2 to 4.1%. Now, they did show 254,000 jobs being created, and they were only expected 140,000. So again, really strong month for jobs. Bad month for inflation, good month for jobs. Both of those are bad news for mortgage rates. Okay, so again, that's part of the reason why we've been seeing what we've been seeing. However, when you look at the underlying components of this data, you see that most of the job gains actually had to do with part-time employment and younger workers. Nothing against younger workers, but when I'm talking younger workers, I'm talking high school, college-aged workers. Well, yeah, they're not the main driving engines of the economy, right? I mean, the vast majority of bills are not paid, with those, part-time jobs, right? So there's some real significant questions around like how reliable is this data. Not only that, here's another sign of weakness: continuing unemployment claims. So with unemployment, they have two different numbers. They have the initial claims, who's first filing for unemployment, and then they have the continuing claims, who's continuing to file for unemployment after the initial claim. Those are at 1.897 million, the continuing unemployment claims, that is, which is the highest level since November of 2021. November of 2021, like that's significant. So we see these headline figures of, yeah, unemployment's ticking down, 4.1%, woohoo. But then when you look at the underlying data, like a lot of part-time jobs, a lot of younger workers, and continuing unemployment claims are, highest level in now 3 years. So it's a question of what's what. Like how reliable is this data? How strong are these jobs numbers really? Ironically, we're going to be getting some updated unemployment figures tomorrow on Friday when we get the BLS report. So more to come on that. But it's a little bit curious as to what's going on that front. All right. So again, inflation had a rough month and employment figures were really solid in October. All that's bad news for mortgage rates. But it doesn't speak to the entire reason as to why rates would go from 6.125% to 7%, right? I mean, that's a significant leap in a month period, a month and a half, we'll call it, okay? So there's an old adage in trading in stocks, right? That you buy the rumor and you sell the news. What does that mean? Well, in the lead up to the Fed rate cut, okay? 5 months preceding it, mortgage rates did improve 1% over the 5 months preceding it. Okay, leading up to September 18th, rates improved 1% about. Fed cut rates 0.5%. Well, what happened was back, 5-6 months now ago, when the traders were first hearing rumblings of, hey, there's probably going to be a Fed rate cut in the fall. And if you recall, I had that date, September 18th date circled months and months and months in advance. It's not by incident, right? We all kind of knew what was going to happen. So what happened? Traders started to buy up mortgage-backed securities on the rumor that the Fed was going to cut rates. And then once they did cut rates, they sold. And they sold those mortgage-backed securities, which caused mortgage rates to increase. They then took that money, put it into stocks, which is why stocks have been hitting, all-time high after all-time high after all-time high. That money has to come from somewhere. It wasn't just sitting in cash under a mattress. A lot of it was invested in safer investments like mortgage-backed securities, like bonds. Okay, so that's a big part of what happened. They bought on the rumor that the Fed was going to cut rates, and once the Fed actually did cut rates, they sold on the news that the Fed cut rates. Okay. Now, here's some good news there. Okay, and this is the news you all have been hoping for. There's some good news. This is actually quite common. Okay, in the last, 8 times when the Fed has began to cut rates, mortgage rates initially increased. Okay, there was only one exception where they did not do that. But historically, and I know there's a lot of data here. This all came from MBS Highway, which is a subscription service I pay for. But there was only one instance, if you look back at history, that rates actually decreased immediately, and that was back in July of 2019. But every other time when the Fed began to cut rates, September 84, November 87, et cetera, every single time, mortgage rates initially spiked, and then they started to come down. This is tracking the 10-year Treasury. 10-year Treasury tends to follow, interest rates tend to follow 10-year Treasury as well. So again, every single time you see a spike here, that means that rates initially increased, and then they started to come down. Now, what we don't know is how far rates are going to come down eventually, right? History would tell us, this is a good data point for you to share with your clients. History would tell us if all of this, pans out, if all of this plays forward, that mortgage rates, long-term 30-year fixed mortgage rates, should settle somewhere in the mid-4s to low 5s, okay? Currently around 7%. So there should be improvement here, okay? It's going to take some time. It's going to take a bit. Fed's likely going to cut rates next month. They're going to likely cut rates in December again. So hang tight, be patient. Relief is going to come. It's just going to take a little while, okay? And again, all this is actually right on par, right? Rates initially tick up and then they start to come down. So fingers crossed that history plays out once again. That would be really good for all of us. The Fed is meeting, like I said, on November 7th. That is not a meeting associated with a summary of economic projections. What that means is it's going to be a shorter meeting. It's going to be a little bit more concise. They're not going to show their dot chart where they say, hey, look, here's where we think rates are going to go. Here's where we think unemployment is going to go. That next summary of economic projections is not going to happen until December 18th. But if the Fed follows their plan that they laid out, we should see a 0.25% improvement on November 7th, hopefully another 0.25% improvement on December 18th. As bad as it was that inflation ticked up, I don't think it ticked up enough that it's going to really change the Fed's course. As strong as the unemployment numbers were, the employment numbers were as well, I don't think it's going to change the Fed's course. Okay. And if they follow suit, they should be cutting 0.25% on the 7th, 0.25% on December 18th as well. Okay. So again, relief on the way. Be patient if you can. I know it's rough out there. It will get better, I promise. All right. So looking ahead, Election Day on November 5th, huge day. Get out and vote. I actually looked it up recently. Colorado traditionally is the number 2 highest participation rate for elections of any state. It was Minnesota, I think, that took number 1, which is kind of surprising. But gotta love that mail-in ballot. It makes things so much easier. Really not a lot of excuses to not vote when you have a mail-in ballot. Cost of postage. Jobs reports due out, update inflation data, and then the Fed meeting on November 7th. Markets are expecting a 0.25% cut. So it's going to be a busy month next month. When I say that, you can say, yes, he said it was going to be. Between the election, updated data, and then the Fed meeting, it's going to be a rather busy month. Hopefully there's some more relief on the way. Hopefully we see some progress on inflation, and hopefully the markets like the result of the election. Hopefully we all like the results of the election. All right. I think that's it. Thank you all so much. If you have any questions for me, please let me know. And thank you all so much for the referrals. It means everything to my team and I. We know it's hard out there. We never take your referrals for granted. So thank you, thank you, thank you, thank you, thank you. Happy Halloween. I will see you next time. Thanks all. Bye.